Does anyone have any questions currently about wherever we are and whatever you've learned? Does anyone have any questions? You can ask in the chat, ask in Telegram, use your microphone. Does anyone have any questions? Okay, so no questions for now. That's all right. Okay, so what we are going to do is we are going to determine how to get a premium and discount range using IPTA data ranges, and that's going to be for 20 days, 40 days, and 60 days. So I'm just going to quickly draw it out here for us, and then we're going to do one live new on the chart and see how it goes. But basically, we are going to sort of separate our chart here like this, and we are going to say that each day, or rather month, that ends consists of how many trading days? Anyone?
20, I guess.
20.
Okay, great. It's 20, correct. So it is 20 days over here. So this is the monthly open, and over here is the monthly open. And then obviously this little guy over here is the low of the month, and this is the high of the month, for example. And wherever price decides to close is, for the next month going forward. So going forward 20 days, the month will then close, and obviously every month, is consisting of 4 weeks generally, unless there's like holidays or Christmas period, generally speaking, there's 20 days a month for trading. Now, obviously here and there, there's sometimes maybe 22 or 18, things like that. But for the most part, there's 20 days. So we're going to work off of 20 days. And if we go off 20 days and we go to the next month over here, sorry, this is not very straight, but it really doesn't matter. Again, another 20 trading days. But based on the end of this next 20-day period over here, this is actually going to have accumulated 40 trading days in total, because we've added up the first month and now the second month, which is 20 days, and then we've totaled now 40 trading days effectively. Okay, and then obviously the month is going to continue, and that too is going to have roughly 20 trading days. And at the end of the third month, we are going to have 60 trading days. Okay, so if we think about a month, that's 20 days, 2 months, 40 days, 3 months, 60 days. Okay, and if we separate this portion of data over here like this, can anyone tell me what 60 days of data on the charts represent?
I guess the quarter of the
Quarterly
year.
shift.
Sorry, what?
The quarter of the year.
Yes, it represents a quarter of the year. So this would be whatever, maybe Q1 of the first part of the year. And if we think about the month, each month is 20 days, each quarter is 3 months, which is 60 days. And then obviously, as time goes on, we've got like Q2, Q3, like this, and then if at the end we'll get Q4. But if we think about each quarter, and we were to separate each quarter up, and we had our own little box, something like that, and then Q3 like this, something like that. It's not very accurate, but really doesn't matter. So this is how it's going to look, and then each quarter is divided into 3 months, which is 60 trading days. And of the quarter that we are in, based on the current range of data where we are, from the highest high to the lowest low, using the candle bodies, not the candle wicks, the candle bodies, using a daily chart, we will determine our premium and discount range. So let's look at Q1 over here, and I'm just going to get like a green, and I'm going to say that in the first month over here, price made a high like this, and then sort of maybe traded sideways, traded a little bit lower like this, and sort of traded a little bit more sideways, and then did a dip down, and then boom, price is now trading at the end of the 60-day period. So what we are going to effectively do is we are going to anchor from this swing high over here to this swing low over here. And what that will represent is, and then obviously in between somewhere here would be the equilibrium. So that is a swing high, a swing low, and in the middle we are going to have EQ, equilibrium. So that separates based on 20, 20, and 20, or 60 days of data, where the swing high and where the swing low of the data range is. Okay, so IPTA is the algorithm. Then what does an algorithm do, or how does an algorithm work? So whenever, or if you've ever studied computer software or anything relating to coding, you'll know that if you design software, you have to have data for it to work upon. Okay, so you can't just design software, it needs data to work with. And if there is an algorithm in the market, we need to understand what data is it working with. Well, there's only two fields that it can work with, which is price and time. So if we understand that IPTA is the algorithm and IPTA data range is the data of what it is working with, then price and time, price being the high or the low of the range, and time being 20, 40, and 60 days. Okay, so we're going to get 20, 40, and 60. And then we're going to get swing high, swing low, equilibrium, and we are going to anchor. And then what we'll effectively do is, let's just get another color here, like purple. So this is going to be the high of the range. This is going to be equilibrium of the range, like this. So it's high, equilibrium, and the low over here of 60-day period. Okay, and in between, okay, there's going to be, if you would like to call them, halfway points or quarter points, premium and discounts of the premium. So within this premium portion, we know that that's the larger time frames premium based on 60 days. But if we were to subdivide from the equilibrium to the swing high, so from the swing high over here to the equilibrium, there is going to be another halfway point over here, which would be the premium, the upper portion of the premium of the 60-day data range. But because, you know, price doesn't just move from point A to point B, we need to know where better premiums and better discounts are. So within the whole portion of this premium and this discount over here lays the premium, which would be sort of this section over here. So that would be the premium, and then this would be the premium discount over here of that given data range. And then we'd basically add another equilibrium over here that separates the two. So within this large data set of 60 days, we've got a high, we've got a low, we've got an equilibrium, but then we've further subdivided this whole range into smaller workable areas where we can use to day trade, swing, position, whatever sort of we wanted to key off of over here. So this is really based on more time than it is price, although obviously price is the swing high and the swing low, but in terms of time, this is where price is really working. Okay, so time being 60 days, upper portion of the premium, equilibrium, premium discount in the upper quadrant of premium. And then obviously this is the discount. So we've got the same idea. If we were to subdivide this discount over here, we would get a discount premium like that. Then we would get the equilibrium of this range over here. And then obviously we'll get discount of the discount. So within just two premiums and discounts, we've got an upper level of discount in the premium array, and we've got an upper level of premium in the discount array. Then we've got the upper portion of the premium, and then we've got the lower portion of the discount over here. And when price is really in the upper quadrants of the premium, and the discount, price is effectively what? Does anyone know what the word that retail traders would generally use?
Please come again with the question, please.
So oversold. I think I missed a little bit what you said there.
Yeah, you're right.
Yeah, just rephrase that. I got the judge between oversold and yeah, something like that.
Well, yeah, that's effectively exactly it, is that retail traders will be using like RSIs or whatever, stochastics, I don't know, whatever they use to determine oversold and overbought. And then these are your ranges. So without using, you know, an oscillator like those, or an indicator, whatever you want to call it, we already know where price is likely to do something significant, that where it has come from and where it has gone to. Without the use of indicators, we can just use it based on price action on a higher time frame, because this we would do from a daily chart over here. We can also obviously use it from like the weekly and the monthly, but you would draw this data set up using a daily chart. Okay, so this is really how it's done based on, you know, just an illustration. So I'm going to go on to a live chart and draw a new one, and then you can see and ask questions based on, you know, that once I've done that. Okay, so I'm just going to pick a pair here, and I'm going to just do this one, use the Swiss franc, and then I'm going to go to my daily chart. So it's pretty easy. We can just do this very quickly and say where the ends of the month are, because obviously if you were to count the candles in here, you get roughly 20 candles in each separator. And when you press on MT4 and MT5, it is Control Y. There's obviously a button for that on TradingView, which I don't know what it is, but you know, you can even get an indicator probably. Really doesn't matter. But generally I do this manually once, you know, or twice a month, because it doesn't change that much. But from this data set, you can see that the month has right now sort of just ended over here, only a couple of candles in. And obviously, if you're living in the States, then you're going to have like a Sunday candle, but really the same thing's going to apply. You're still going to have the month end, you're still going to have the month beginning. So monthly open, monthly close kind of thing is still going to be the same idea regardless of where you live, because we're working with the chart data. But anyway, so we are on the daily chart now, and we can basically say that the month has just ended. So we've got this over here. So this one here is 20 days over here. So this would be 20 days ago within this data set. Then this would be obviously what? 40 days, right? 40 days. Then this would be 60 days over here. So when we get to this data, that is the time that we are looking back, is what we would call it, looking back, look back data. So 20, 40, and 60. So within this 20, 40, 60, obviously you'd sort of just do a new one when the month ends and begins, and you'd have a new set of data with maybe a new swing low or a new swing high. So let's just work on this data set that we've had over here, and then obviously this would have been 80 over here. Only 80 now because obviously the month has ended. So the month has ended, but prior to the month ending, that would have been your 60, but because the month's ended, it's now just become 80 over here. So within each month, there's going to be a high, there's going to be a low, then there's going to be the one that we use to anchor. So within the 60-day period over here, looking back to down here, this would have been the low. So we would have anchored I'm just going to make that red so it's easier to see. So we would have looked at that being the low, because we are looking for the lowest low in terms of closing price, not the wick here. We don't care about this wick here. We care about this body over here. So when we do that, we anchor over there, and then we count. That's 20, that's 40, and then that's 60. So this would have been the high over here before this month ended. That would have been the data range that we were working within. This would have been the high because that's the body high, not the high of the wick, the bodies, and that would have been the low. And then we would have got equilibrium of the range. So I'm doing it like this so that I can show you what to do when the new month ticks over. Okay, so this would have been the equilibrium of the range, like that. And then, so now, just going to remove those date dividers. Now we've got an upper portion of premium and we've got a lower portion of discount. Now within this subset of data, obviously we know that the higher time frame, when it's in the premium, it's sort of sell kind of scenarios, and when it's in the discount, it's buy scenarios. But we can further subdivide this, like I said, where we quadrant this further. So then we would have over here another 50% of the discount. And if we were to move this over here, we'd have a 50% of the premium. So now, although we are separated over here into this whole section of premium, this upper portion is the premium. This is the discount portion of the premium. Then we've got the equilibrium. Then we've got the premium of the discount, and then the discount of the discount. Okay, so let's just put our date range back here, and then we can say, well, where is the liquidity? So the liquidity would have been above that high. Notice I'm using the swing point, not the candle closing. So we are anchoring the data range on the closing price, but we are looking for where liquidity is based on also the wicks. Okay, so there's liquidity there, there's liquidity there, and over here there would be liquidity below this low over here. Then there would have been of this month's low liquidity there, and this month's low liquidity there. Okay, and then obviously this month's high would have liquidity. So really what's happened here, okay, now we can remove our date separators. We've got upper portions of premium, discount premium, equilibrium, premium discount, and discount. Now we are going to do it so that we can actually use this to trade sort of intraday. Okay, so we've got these 1, 2, 3, 4 quadrants of data, of this data range, of the 60-day data set over here. And our most recent anchor point before the month ticked over would have been, you can't probably see that, so I'll just make that a darker red. So the month has just ticked over here. So this is the last day of the month, basically, over here. And counting back, so this would have been the previous month, last day, previous month, last day, previous month, last day. So 20, 40, 60. Okay, and then we've subdivided it into the discounts and the premiums, etc., etc. So we've sort of quadrantized the data, if there's such a word as that. We've quadrantized it, and we are working within this data set. Now we can further get a level of premium and discount within each of these quadrants as price moves. So how would we do that? We'll just take a quadrant, any quadrant, because they're all now the same size in terms of like pips and things counting up. So let's just double check that. So from here to here is about 198 pips. So then generally this one should be about 198 pips, give or take. Okay, it's 200. So what? This one 200, this one 200. So these data sets are equal in terms of size. Okay, then we're going to take another fibs, and I'm saying fibs because it's the easiest, and we are going to draw something like this, where this box, this quadrant can be divided into discount and premium over here. So let's just put this as a light green color, something like that. So that would be your discount of, like, if you were trading on a lower time frame, 1 hour, 4 hour, etc., etc. And then if you were to copy this and make this like a reddish color. Okay, so now within this big data set of 20, 40, and 60, you've got lower time frame data sets of actually tradable time frames, because being realistic, most of us wouldn't execute a trade off of a daily chart. However, you know, bias would come from a daily, weekly, and monthly. So this is a blend of daily, weekly, and monthly, because obviously what we've done here is we used the last 3 months candles, or the last 4 weeks each. Okay, each candle, so it'll be 12 weeks in total, and then obviously it's 60 candle days roughly. So that is how we've divided this, and then now we are subdividing one of the quadrants into a further premium and discount over here. So how this would work is that when we are working within each data set, so like over here, this would have been the previous data set over here. So that would have been the last day of the month. So your anchor point would have changed from here to here. Okay, but it hasn't yet because we're still working within the month. And as price trades up, we are going to move these boxes based on a 4-hour time frame over here. Okay, so we've got these little boxes that we've drawn up here, representing each quadrant's premium and discount, and obviously the separation between the two here is equilibrium. So generally, most consolidations will occur near an equilibrium point, whether that be an equilibrium point on like a daily chart, a weekly chart, a 4-hour chart, a 1-hour chart. When you draw any kind of range of data, whether it be a swing high using IPTA or any other method, generally an equilibrium would equal consolidations. That's where they're most likely to occur. Okay, so using this information, we will go to a lower time frame because we've subdivided this. So let's just pull this so we can see it on the 4-hour. Okay, so we've divided this range up over here. And what we're going to do with this is that because the data doesn't change that much, so to do these ranges not change that much. Obviously now being on a 4-hour, they would change based on the 4-hour, but this is effectively how you would use it. So price would have come down in here, following down as the price closes on the 4-hour chart. Discount, you can see here would have been a discount because you anchor the top and the bottom of these ranges to these sort of red lines that I've drawn here. You can go and sort of, you know, color code however you want to, but I'm just showing you how to do it. So as price would have moved down, you would have seen would have come into a discount, and then there was some kind of consolidation over here, and then boom, price traded lower. So where would discount then be? Because the 4-hour chart closed over here, so it would have closed down here and gone lower, so you'd have to move this box down into a discount, and then as we get to the end of the range, you can see how turtle soup's sort of outside of this box over here, and then boom, over here trades back up into the equilibrium of this range, and then back down into a discount over here. Okay, and when it does this, obviously this is a discount of, say, a 4-hour / daily time frame, and even if you want to use a 1-hour, that's fine too. Okay, but generally this is where your IPTA data ranges, premium discount range would come from. Okay, so this is the sort of advanced way of doing things rather than just anchoring from like a swing high and a swing low kind of thing. This is more specific, especially for, you know, lower time frame reacting off of a higher time frame. Okay, so this is your discount, and you can see a price sort of left the discount over here, and then it closed above over here and continued higher, rejected this premium. So let's just zoom in there. It rejected this premium range over here, came back down probably to that last 4-hour order block maybe, and then left the range, and it closed above here. Now you notice that this would have been the premium over here in this red box, but because it closed outside there, we would have to change this. So now this becomes the discount and this becomes the premium over here like this. And then you'd be using it based on 4-hour, daily, 1 hour, whatever you wanted to do. So this would be your discount, and then when price exceeds this range over here, you can see it closes outside there. Boom, we move this back up over here, and then this becomes the discount again. So you just move these boxes as price moves around on the 4-hour chart, and then each box corresponding to premium and discount would be that given sort of intraday price actions trading range, more or less. Okay, and then obviously we are not incorporating any other items of your PDA onto this, because this is just a 4-hour chart. But that's probably would be the next question, is that what am I keying off of here? If these are your data ranges, this is your premium and your discount, you will incorporate higher time frame PDAs onto this. Okay, so all very well, this is discount, this is premium. If price decided to stop here like this, what could be at this point or near this point based on a higher time frame as to why price would have wanted to maybe reverse? And the only way you'd know that, if this data range is based off of 20, 40, and 60, and we are doing this quadrant subdividing to get a discount and premium array, then you'd want to use sort of like daily and weekly arrays to see the reaction to those arrays. So like this is 4 hours, so we go 1 time frame higher, and if we zoom in here onto that price action, we would have sort of marked maybe this zone up over here where we see this down candle being traded through, and then this would be some kind of order block, or even maybe a lower time frame breaker based on what this looks like over here. That would just be the daily. And if we were to look at the weekly, for example, well, you'd have to mark out the weekly. So when price traded higher here, it left the discount, traded into this premium zone. What, based on this weekly chart, can we see anyone that price traded into here? Can anyone see anything that price traded into off of this weekly array?
That seems like a rejection block.
Sorry, at what?
A rejection block.
Yes, you're correct. So there's actually 2 things I see here. So this is a weekly time frame. So obviously this would have been the
Yes, yeah. There's another order block, weekly block.
Yeah, so price would have come in here and then traded lower, maybe traded into this weekly void over here, and then traded higher. And when it traded into this rejection block, it rejected down, and off of this weekly block over here. Sorry, can you guys mute your mics, please? And basically when price came in here, like you said, I think it was you, Manuel, when it traded into this area over here, this would be a weekly rejection block, not seen on that 4-hour unless you mark up the higher time frame PDA. This is your weekly rejection block. So price, you would have marked it up and done something like this. If that's a rejection block, I'd generally just make it like a dotted line or something like this, and then I know that that's like a weekly something, and then maybe I'll label it on a daily or a 4-hour chart, so that when my 4-hour array trades into a higher time frame, I would be looking based off the 4-hour or the 1-hour to sell this array. Okay, so obviously here you can see it came above this high, traded into the rejection block, and then there was this sort of sell-off that occurred here. Now, generally, either, unless you like swing trading or position trading, you're not going to be entering, those charts or those trades off of a daily. You'd be entering off of like anything lower than a 4-hour or lower. So obviously that information is quite useful based off of a 4-hour and lower. So this is a weekly rejection block. Like we said, there's also a swing high that occurred inside of this premium over here. And if you were to go down to like a 1-hour chart, you'd obviously get a lot more information over here. So price would have taken the high of the swing high, having retraced lower, there'd be a buildup of liquidity, and then boom, price trades into the weekly array and then rejects. And when it rejects, it obviously creates other arrays on other time frames. So like this would be like a 1 hour rejection block off of a weekly rejection block. So sort of combining higher time frame confluence or confirmation with lower time frame confirmation. Okay, so this is where the confirmation part would be coming from to grab yourself a premium and a discount array based off of 60 days of data. And like confirmations include whatever's in your array, rejection blocks, old highs, order blocks, voids, fair value gaps, mitigation blocks, breakers, etc. Okay, and using those elements of price from your PDA, you are attaching it to this time element of 60 days worth of data, and you are coming up with sort of a conclusion that it's in a premium now, so I should anticipate it to sell. So if we were to go back to the 4-hour chart here and look, or sorry, the daily rather, if we looked at the time element of things, 20, 40, and 60, when price came in here, this would have been the upper portion of premium. Even though it's in the discount of the premium, okay, it's still in the upper portion of premium over here. And you can see the reaction off of taking that high, trading into the weekly rejection block. It's not looking good. And then over here, when you go down to the 4-hour, you basically just follow price as it's now reacting off of your weekly zone. Okay, so price would have effectively traded lower here and closed outside over here of your discount zone. So when that happens, well, you just follow price again, like this. Where would I anchor it? At the next quarter point or quadrant point, and then this would be your premium over here. And then you just basically trade like you would of a 4-hour, for example. So like, for example, here we had this sort of failure swing where price came up, retraced into this zone here, which you can also see is just trading low resistance liquidity runs, and then price would have retraced. So this is a lot of confirmation going on here in terms of time and price. And obviously what you learned about things like SMT can also be applied to this exact chart. So you've got yourself a premium based off of a higher time frame of 60 days of data, and you're working off higher time frame PDAs, discounts, premiums, weekly charts, daily charts, and then you're coming down to your 4-hour or lower to get something to trade off and target. Okay, so it is natural that when we look at when it reacted off over here, so obviously you'd mark up your daily chart. You can see there it traded lower, and if we mark this chart up at that time, there would have been a daily gap or SIBI over here when that price closed. So going back to that 4-hour, when you follow price on the 4-hour, although that's just a 4-hour gap, you'd have to chop and change between different time frames to tell you more information. So this is just a void on the 4-hour low resistance liquidity run, but on the higher time frame, that's actually a daily void over here. And the price would have come into discount, reacted, traded below these swing lows over here, and then price would have retraced higher, coming back to close this void in the premium section over here. And notice how it leaves this 4-hour void over here open, but closes the daily, and price gets sent lower over here. And then again, boom, where's the next objective? So you're basically just trading from one level of premium to one level of discount, and then it reacts off of the premium. So then you're going to exit your trade at the edge of the next array, which would be over here, because that would have closed below over here. So I'm going to just end for now. So when we look at the chart, then what I've just showed you in terms of how to get the array that you are working with based on 60 days of data, the swing high and the swing low, you will effectively come up with something like we've just drawn over here on this 4-hour chart. And then at the end of the month, this...
Hey, Darren, just want to check if everybody is hearing you clearly. I'm getting you a bit intermittent on my side.
Everyone, can you hear me? Is anyone else having any problems?
Yes, I can hear him perfectly.
Yeah, all good for me too.
There must be something on your side, Roger. Okay, so when the month ticks over and the new month starts, that 60-day data range will have swapped over here. So now that 60, so this 60 would have been here. Now that 60 becomes over here because the new month has then started over here when this month, and then that just changes. So whatever was before comes after. So this would have been 20 days, and then now it becomes 40. This would have been 60, now it becomes 80, etc., etc. Okay, so this month ticked over, then this is 20 days, this is 40, and this is 60. And before this month ticked over, this would have been 20, this would have been 40, and this over here would have been 60 over here. So basically what we're saying is that when price comes up to the highs over here, this is considered a premium, and when it goes to the lows, that becomes a discount. So notice how price over here trades lower at the end of the month and takes the liquidity of the previous month over here. So when it does that, yes, sure, that is lots of liquidity sitting over there, but at the same time, there must be something here on the weekly, on the daily, on the monthly that could influence the decision-making process. So even though there's liquidity there, maybe over here, based on the weekly or the monthly, other than what we're looking at over here on the daily, there must be some other confirmation here. Maybe like a break, a void, a order block, or something like that's part of your array, but from a higher time frame perspective. Because we know that if price is to come outside here, this is considered a discount over here. Even though it's not the lowest level of discount, we are still inside, because as we follow price down, you can see it trades to the end over here and sort of has this reaction over here. And when it has that reaction over there, maybe you tried to take a trade and you lost it. But what you also see is that when it did that, it didn't take this low of the previous month. Now, generally, I wouldn't take a trade if it's like just missing that low. Like you can see there, that would have been the low of the previous month over here. And it would have made equal lows. And then, boom, what does price do? That would have been closing below this discount over here. So then you just move this down over here, and then this premium moves in its place like that and like that. So now this would be the new discount array, and based on 60 days of data, if we zoom out here, trading below an old low is a form of discount over here. And then you'd be looking to trade 4-hour arrays based off of this 60-day data range over here. So 4-hour order blocks, voids, 1-hour order blocks, voids, breakers, whatever you're going to find would be discount. Okay, quite a large discount over here. And you can see that when it left the discount, it traded right up into the premium over here and paused right there. And for now, you can actually zoom in there. We can't really count this because it sort of just closed at this point over here. So we would still be using this array over here as a discount and premium array. And until price visibly, noticeably closes outside of this premium, will we then shift this up to the premium, and this will become discount over here. So that's currently what we are working with now on this given pair. So that would be the premium, this would be the discount over here. And like, for example, maybe price would, I don't know, come in here and sort of, you know, trade below this low, just tapping into this discount. That can still be considered as a discount. And obviously this is just a 4 hour, but if we were to overlay something of significance on a higher time frame, what we may find is interesting, and that would be there's like this leftover void sitting over here. So there's actually a void here. So from this high, which is 95,339, so we just put an anchor point on 95,339, and then we could say that this is a daily void over here. So if price on the 4 hour trades into this daily void, we would be looking for a reaction off of this over here, because we've already come from a discount based off of a higher time frame 60-day data set. And then this would be your liquidity pair up over here. So that would be sort of relative equal lows over there. And then obviously we've come from a high, we've made equal highs over here and over here. And if we were trying to buy this, we'd be looking to exit out of this array. So let's say price came in here, down, take the liquidity, maybe show like a 1 hour order block or an SMT or something, and we enter the trade. Our target would be to exit this range over here. Yes, we can target the high, no problem, but just remember that there'd be equal highs on the closing price as well, so that's a good target. But I'm just saying that would be a likely target if price comes in here, closes this daily void, maybe there's even a lower time frame SIBI over here, SPICY rather, on the 4 hour right there, something like that, and then use this liquidity pool as sell stops, and then buy up those sell stops. This would be your next target basically. Obviously not your only target, because if price continues to go lower here, there'd be a SIBI over here, which too is an institutional reference point, which is, as much as it is a reason to sell, it is also a reason to exit a trade. So old high, order block, void, we buy down here, then we can use that as a target, or this as a target, or this as a target. Any questions? Okay, so everyone understands exactly what I'm saying then, because no one's got any questions. I think it was you, man. Go ahead.
No, you go ahead. Go ahead.
Okay, so I think it was Emmanuel that's asked how to determine strength or weakness. Was that you that asked that?
Yes, I did ask it that on the chat on the Telegram.
No, that's fine. So basically, this is your data range that you're working within. So what I've explained here is pretty easy. There's nothing really too difficult about this. This is just to divide up the chart into compartmentalize it like lower time frame, and then you trade these arrays as and when, you know, price does whatever it's going to do, because I don't know where it's going to move, because right now it's sitting at the equilibrium of this range. So right now, either if I was selling, I'd be selling up top here. If I was buying, I'd be buying sort of down here or underneath that low over here, or this order block or something like that. So this is pretty self-explanatory. There's nothing too difficult about doing this. The only difference is that when you, for example, you know, maybe you were doing something like this, getting yourself a swing high, and then getting yourself a swing low, something like that, and then you'd say that this over here is the upper portion, and then that's the lower portion, and then over here would be sort of the 50%. That's fine too, okay, but it's not really higher time frame based. This is what I'm showing you now is based off of 60 days of data. So the relevance to what happened only most recently versus what happened throughout 60 days, it's more relevant to trade 60 days of data. Now, you don't have to. The way I've showed you now is using 60 days. Okay, you don't have to use 60 days. You can do the following and use 20 or 40. Okay, it really depends on yourself and what you would like to do, but I personally use 60. Okay, and it's, you know, maybe not the most accurate for like 15-minute charts or 1-hour charts, etc., you'd probably find better accuracy using like a 20-day, range of data. So for the last 20 days, basically, you just count the candles. So there's candle 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So you can see there's the swing high and here's the swing low. And then you're basically trading 20 days instead of trading 60 days. Now, the reason I use 60 is because obviously, like I said, it carries more weight than, whatever happened in this particular range. So using 60 days carries more weight, more liquidity, higher time frames. And there's a lot more at play using 60 days of data than just using 20 days. Now, each has its own purpose, but what I've showed you here is how to, target a potential array that if you were buying from one, where can you look to exit at another? So I've told you before that the institutional reference points are quite valuable in terms of entering a trade or exiting a trade. And now I've shown you where they would appear. So if you are taking trades based off of whatever you're going to normally take them off of, maybe a combination of what I showed you last week with like SMT and some type of confirmation, where can you look to exit this trade, or perhaps take a new trade when you've taken the existing trade off the table and you've profited? Where will the likely next trade occur? And that is basically what we see here. So let's just quickly remove some of the stuff here. And let's couple up some higher time frame stuff here to see what's going on. So although over here, this is based on higher time frames, 60 days of data, when price traded lower over here, let's look on the weekly. So when it traded lower, it took the liquidity, but it also did what? What did it do? What do we see it doing on this weekly chart? Anyone? If this is the swing low over here of the previous month, in that week, below the swing low, what do you see on the left of the chart?
Just a bit busy.
It closed a bit of the void.
Okay, so then this little guy over here would have been closed by this candle trading lower, but then it price traded lower and lower here. So there's still, like you said, a busy or a bullish liquidity void sitting here. So it takes the liquidity of this low, the swing low here, trades into it, and this is a reason to exit the trade as much as it is a possible reason to enter the trade. Oh, sorry, actually, it actually closed most of it because I didn't see that wick over here. This wick actually goes right into that civvy there. So the low of this here is 95.020 and the high over here is 94.439. So this actual busy here is closed because if you look there, there it is. And look on the daily, price traded even on the 4-hour into that zone there with that wick there. So that was actually closed on the weekly chart there, this busy over here. Now that's as you can see from the weekly chart, that the bullishness of this chart, the order flow is bullish based on the weekly. So this little move down here, this little move down here isn't, this is, we can consider retracement over here, because even if we looked at the monthly chart, there's this huge void over here. So based on what happened prior, based on 20, 40, 60, our bias is bullish because the monthly just created this huge void. And actually over here, it's like a bonus factor is that there's the swing high of the previous month over here. And of the swing high over here, which is on the weekly chart, this swing high here is the monthly high of the previous month. So this is actually a monthly busy over here, And then just the lower time frame busy over here on the weekly chart. So monthly is bullish, weekly is bullish. And then if monthly is bullish, weekly is bullish, then 4 hour and daily, if that's bearish, like it looks here, go here, so like bearish, it failed to take out that high, traded lower. So 4 hour bearish, daily bearish. What's the next higher time frame than 4 hour and daily? Well, it's weekly and monthly. So weekly traded into the SIBI, or the BISI rather, and then found a reason to buy. So now, not only is that a discount area, but the order flow is bullish on the weekly, the order flow is bullish on the monthly. There's a liquidity point over there of the previous month over here. So as price trades higher over here, this starts to generate new liquidity. Like there's a whole pool of liquidity, because as each day goes higher and that low doesn't get taken, liquidity starts to build up below that low for people who are trying to, trade higher. So price did effectively that. It took out the liquidity of this low, traded into this weekly buy side imbalance, sell side inefficient. Okay, what else can I use here, guys, to determine what could likely happen that if price is going lower here? What else can I use? If I've just showed you that there's a discount here, there's a liquidity pool there, there's a weekly SIBI, a BISI there, what else can I use here? What did we
If you want to buy,
Yeah, like if I'm seeing that price is trading below this low, and if the general populace is saying that, well, if it breaks this low, it's it's bearish, they're going to sell the low because they are willing to sell at lower prices, right? Right?
so come again with the question.
Correct.
The question is that if I've just showed you all of this confirmation, like this BISI on the weekly,
Okay.
this liquidity point of the old low of the previous month, this being the 60-day data range discount, what else can I show you that would shed some light on, is this weak or is it strong?
If you want to buy or you want to sell, what you're looking for.
Well, I'm trying to tell you that if it's breaking that low, it's at a discount, the bullishness on the monthly, the bullishness on the weekly, what am I?
SMT.
Thank you. Yes, because I want to see, is the dollar index also that weak over here, right? Because if it is weak and it's penetrating this low for the sell side liquidity over here, then I want to see also that the dollar index is also, weak over here, right? Not so? Because now I've got all this
Yeah,
confirmation. I've got all this confirmation, but how can I back that idea up? Because this is just one pair, right? It's one pair. How can I use something else to tell me and confirm this? Confluence it with an SMT, exactly like Roger said. So if I come over here to the dollar index, okay, now because the dollar index is USD, right? What do I need to do?
looking for a non-symmetrical.
Okay, but the chart is USD, right? It's USD Swiss franc over here. So USD is the quote pair, and because USD is the quote pair, it's going to move the same direction as the dollar index. So what do I need to do on the trading view?
You need to flip the USD.
To invert.
Yes, guys. Yes. So you need to invert the chart. Why do you need to invert the charts? Because USD Swiss is the same direction as the DXY. So you want to see times when it is not the same direction. So that when the one buys, the other one should sell. And because this is not GBP USD or Euro USD, it is USD as the quote pair first, means it will move in the same direction. So there we go, invert scale. Okay, then we're going to go to that daily chart we just saw over here, and then we're going to look at what happened. And oh my greatness, what has happened? When it took this low over here, look at that. Where's this low? Is this high? Where's the higher high? There's no higher high, right?
There's no higher high.
So then when this month's high and this month's low was formed, and now recently price took the low of the previous month, did the DXY take the previous month's high? No.
No.
So what is this? This is non-symmetrical, right?
Non-symmetrical, yes.
Okay, so now not only do we have a discount, a weekly BISI, a monthly BISI, a old low of a previous month, we are in a discount. We also have SMT from this low to wherever this low is over here somewhere. So there's SMT over here. So if that doesn't shed some light for you guys on, you know, whatever you've been doing past up until now, then I really don't know what is going to shed light that's going to change the way you look at the charts. Because for me, that's pretty clear, is that we have this higher time frame bullishness and this inefficiency plus this old low plus price moving below that low and the DXY not moving above that high, creating manipulation over there. Does anyone have any questions?
Darren, could you just repeat that about the shedding light bar, just like confirm what, like that checklist you just gave me, you just run through that one more time, please?
So before we met possibly Temitope, maybe you knew a bit about ICT, you were looking for order blocks, or you knew about fair value gaps, or maybe you knew what a breaker was, or maybe you watched my YouTubes and you're following order flow, or whatever it is that you somehow figured out or learned from ICT prior. Okay, now learning what you may have known already, plus what I've now shown you in the past few weeks, this should significantly turn the tables of what you were seeing to what you should see now. Because, you know, maybe you were just following the crowd and, you know, everyone else was selling, you were selling, everyone else was buying, you were buying. There was an order block here, you traded the order block and, you know, it sometimes failed, sometimes it worked. Now you should be able to determine with much greater price anticipation skill, as well as knowing which array is correct and which one is not, using the confirmation versus confluence procedure. That's what I mean.
Okay, cool. That makes sense. Thank you.
Okay, but does this make sense though to you, Temitopia, of what I've showed you now?
Yeah, no, this definitely makes sense as well. And what you just went over makes sense too. So yeah, thank you.
And did you watch the video last week though?
I haven't watched last week's session, no, but now
Okay,
that you've
so
sort of gone over it a bit.
If you watch it, this should make a lot of sense to you. Is there anyone that was or has watched last week that this doesn't make sense to them? Speak now, or forever hold your peace. Emmanuel, you were here pretty much all the time. Roger, you were here pretty much all the time on every session. Does this not shed new light for you on using IPTA data ranges, defining premiums and discounts, confirming and confluencing a trade setup?
No, it does. It does a lot. Actually, for what we learned today this far, so this looked like one confirmation, your confirmation in the trade, right? On this 60, 40, 20 days.
Yes, because look here, this is just this pair, right? But if I go to a pair like, for example, GU, right? Now over here, This is basically the same thing that you're looking at over here. So I've come from this area, and maybe you can't see the lines, maybe you can, but over here would have been 20 days, 40 and 60. So here's the swing high, the body swing high of 60 days, and the body swing low of 60 days based on this trading range, because 20, 40, 60, this is the highest high body close, and this is the lowest low body close. Here is the equilibrium,
Yes.
and then I've subdivided these quadrants over here, which gives me these ranges, this premium, this discount. So when I was trading last week, I already know that it came from a premium, and I didn't sell that, unfortunately, but so what? I knew that it was in a premium, and all I need to do is just wait for my setup over here. So again, I'm trading in a premium, an already given premium. Notice how it trades into this premium from this weekly bearish order block over there. So we knew that there was this weekly bearish order block over there, like I said. And when price was trading in there on the dollar index on the weekly, was the DXY doing the same, or was GU doing the same? So if we see here, last week traded higher, it traded into the close of this up close candle, which is that sort of bearish order block that we see over here. And if we draw a line out in time over here, this open and close is the same open and close of this candle here, right? So if I'm looking at the close of this over here, this bullish candle, what am I looking at on the DXY?
You are looking at the open of the bearish candle.
No, that didn't make sense, Emmanuel.
Okay.
If
So
I'm-
if you're looking at the
If I'm
Close
looking,
of
you're
the
looking-
DCS.
yes, precisely. So although you would think, Emmanuel, so I get where you're coming from, and if I'm looking at the close, then I'm looking at the open because it's opposite, its mirror image. But I asked where the open or close is. So for this example, I said the close. And if I'm looking at this close, which is where I've drawn this purple line here, then the close of this up close candle is the close of this down close candle here, right? Does that make sense, Emmanuel?
yes.
Okay, so when the DXY over here, let's just remove this line there, when it traded over here into this zone, well, not even, it actually didn't, but GU did. Like I said last week, okay, this alone is the SMT here. So if this is the rejection block, why is the DXY not trading into this rejection block here? And that's because it's SMT. Because remember, SMT can form off of any array. As long as you know how to read the price action and what array you're looking at, you can read SMT however you want to. Yes, SMT is mostly done off of swing highs and swing lows, which is the most effective way to do it. But this too, based on the higher time frame, is also effective. I wouldn't suggest doing this like on 5 minutes and things like that. Rather use swing highs and lows when you use SMT on lower time frames. But in terms of order blocks and mitigations and things like that on a higher time frame, daily, weekly, then that's fine doing it like this. Okay, so if we knew that when this was trading into the rejection block and the DXY wasn't, that is non-symmetrical, and therefore this is bearish. And based off of our array, if we are trading higher here, this move higher is manipulation over here, because the DXY is not weak. So they are accumulating the DXY and distributing GU over here. And it's not like I'm trying to teach you, although you could, if you spend enough time, to catch the highs of the week or the lows of the week. You just need to determine a bias, have a bias, and catch some portion of whatever day you want to trade or every day you trade. You just need 50 pips, because if you can significantly predict a bias, at least, you know, out of a 4-week period of a month, just be right, you know, maybe twice a month on your bias, then there you go. More than 50 pips is coming your way. And to do that, all you need to do is define where your discounts and your premiums are. Notice how when price trades lower here, this would have been the array for the premium, and then it would have just turtle souped sort of in this discount, which would have been outside the discount, and then it would have traded back up and then traded lower, and then now you can see it's turtle souping outside of this IPTA data range. So what I'm showing is like these lines, although they are predefined, you'll find noticeable reactions off of these zones when they get there. So sort of what I've drawn here is something like that. So I know that this area of the given 60-day data range is the current working premium, because price hasn't, you know, closed above here. And based on what's happened last week, based on the daily, 4-hour, based on the interest rate change that made the pound lower, okay, the interest rate lower, that is a sign of macroeconomical weakness. So macro to micro, micro being your technical chart. And over here, you just mark up your arrays that you find. So I got a couple. I've got this bearish daily order block over here. There's also this sort of SIBI over here. It's just made the swing high recently now in the London session. So that's a good place to maybe turtle soup for, you know, tomorrow. Okay. And boom, if price comes into one of my arrays, maybe this bearish daily order block takes this high. Maybe there's an SMT there tomorrow. I don't know. Okay. But I am going to watch for a potential sell from one of these arrays, whether it be tomorrow's high being taken, or sorry, tomorrow's taking yesterday's high, which is today over here possibly, or maybe that happens in the New York session. But either way, I've marked up within my premium and discount range where I find potential areas that are tradable for my whatever trading strategy, if you'd like to call it. Okay, and with ICT, there's sort of subjective versus objective. Objective being, if you know what an order block is, it's an order block. Subjective is either you trade that order block because you think it's going to sell, or you think it's going to continue higher based on something else that you found in the market. So objective versus subjective. And there's really nothing new I'm showing you here, except for the IPTA data range and how to, you know, attach it to your chart. But basically all the pairs that I would ever look at would have some kind of array. So the most up-to-date ones would be my EU-GU kind of thing. And even over here last week, I think it was last week, was it? Yeah, last week, sort of Monday, Tuesday, we took this liquidity over here, and you can see how at the edge of the array it is at. Now, it doesn't always have to go to the utmost toppest level of the array, okay? If there's confirmation or a reason why you're selling, obviously selling in the upper portion of the premium range is a good place to, you know, start. And, you know, as you see here, when it traded lower, what is it doing? It's trading lower, 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 and, you know, wherever it gets to in terms of this discount array, you'd sort of just stop selling. Even here, you can see it traded up. What did it do? It traded into this premium, which is sort of the separation point of that premium and discount array. So as price is moving, 4-hour, daily, weekly, each day that opens, each session that opens, closes, your array is changing, okay, but your zones are not changing that often. Like your premium zones aren't going to change too much, your range that you're trading is not going to change that much. Significant news events obviously make the market more volatile and maybe make new arrays, but, you know, obviously eventually it's going to leave a particular array. So like over here, there would be a long-term low over here, and that would be sort of the outside of this discount. So maybe there's a small turtle soup over here, depending on what the DXY does also. and there's like a turtle soup here. So if that's the case, then maybe price would like come down here, reject, and then, you know, retrace back to like the weekly open, for example, or I don't know, close this high over here with this imbalance, something like that. But as it is now, like for example, if price goes bullish from here, this is in a premium array of the given data range. There's a swing high here, there's a gap, there's an order block here, and then there would be a SIBI outside here based off of the daily time frame over here. So all of my arrays based on what I see or what is relevant to me is marked. Okay, so last week we said that over here was a SIBI. Does anyone remember that?
Yes, I do.
Okay, so we said that when this SIBI over here was traded into by EU based on this 4-hour chart, and we look at the DXY on EU of that same 4-hour chart, and we look at Friday's price action over here, here it is trading into that SIBI. That's exactly what I said. Before this 2 candles formed here, I said that over here is a SIBI, which is sort of this same area over here, and you can see that the DXY would have closed the corresponding BISI because it would be opposite, whereas EU did not. Okay, and you can also see here if this was the sort of move the buy before the sell, and then that would be like your order block type thing. Why did the DXY also not trade into that low, which, you know, EU did kind of thing? And then even when it did, that is a confirmation to sell. Notice how it also occurs inside of a premium array. Before it sells, we already know that I don't have to pull from this high down to that low and say, well, oh, price came into 70.5%. Yeah, sure, if you want to do that, no problem. But I'm showing you marking up an array like I have, defining a premium array. I don't need to continuously look for swing highs and lows because I already know that selling would occur in that given array, backed by a confirmation or a confluence from DXY, for example. So nothing's really changing from today, guys. The only difference would be is implementing your analysis using your IPTA data range, finding your discount, finding your premium, and anchoring it. So I'm going to do it one more time, and then I'm going to ask some few questions based on what I've said and see how well you've listened. And then also there was a couple of questions from previous lessons. I know you, Emmanuel, had a question about strength, weakness, etc. So yeah, let's just take Divakara, now that you are here. If you can or can't speak, it's not a problem, but I know you like gold, as many others do. And you learned about silver being closely correlated to gold. Is there another currency that is related to gold that you can use for SMT?
Hi there. You're asking about the currency.
So if I was to come over here onto gold for my chart, and
Okay.
you know now about silver.
Sorry, Darren. We can't see your screen.
Okay. One second. So what currency is linked other than silver to gold, guys? Anyone?
It could be any currencies that has USD, right?
Why USD?
So because gold is related to, I mean, this pair, when we see gold, it is always related to USD, right? XAU USD.
Okay, but what about XAU GBP or XAU AUD or XAU Swiss franc or XAU, whatever.
Oh, okay.
There's not only XAU USD. There's not, right?
Okay. Yeah.
Am I right or wrong?
Okay. I mean, after you taught us, right? After you told that this gold can be correlated with silver. Then after that, I got that insight that okay, we can use silver as an necessity to correlate with gold, but others, I think I have to check.
Okay, but without checking, off the top of what you think you know about gold, what
Okay.
currency do you think would be closely correlated, if we could use that word, to gold? Currency.
Currency.
You could pick any currency in the world. If you don't know, does anyone else like to know or have maybe want to give it a try?
GBP.
One at a time.
Euro USD.
Euro USD. No, not Euro USD. Okay.
Okay, is it again something like XAU GBP or something like that?
No, but without using like gold again, or without using silver, or like a commodity difference,
Okay.
like an actual forex currency that is tradable on the markets. What currency?
Is it USD CAD
No.
or CAD USD?
Nope.
Great.
Go quickly check your MyFX
Is it-
book correlated
is it-
pair.
Is it USD yen?
No, not quite. Ah, yeah, typing.
Yes. Google says CAUD USD.
Okay, look here. USD ZAR. South African Rand. Does anyone know why?
Oh,
Is that even
no
possible?
idea. No idea.
I was thinking about it, but now I was
Was it so
doubting.
volatile?
Okay, so I'm going to tell you the why, and it's not going to be due to supply and demand because South Africa has got lots of mine workers. Yes, I agree that South Africa, if you know anything about it, has got a lot of mine workers, and there's like supply based on or demand based on if they're mining or if they're striking or if there's too much gold or too little gold and the price goes up and it goes down. No, I'm talking specifically, and I'll always go to price action, not supply and demand. Okay, so I'm going to add a new pane here, in addition to what you know about silver. Okay, we're going to just quickly look here. I just want to change that to candlesticks over here. So based on what we see here, okay, this is now without flipping the chart, guys, because remember that XAU is the quote, whereas USD ZAR, USD is the quote. So you don't have to flip the chart, right? Because when you do it with silver, USD is not the quote pair on both. So that's why you have to flip, okay? Whereas here, gold and USD versus the ZAR, okay, South African Rand, it's already not the quote pair, so you don't have to flip it. That's why we don't have to flip it. Okay, so whether you knew this, whether you didn't, it's not a perfect symmetrical market either. Okay, so it's not always going to give you every single void that doesn't close on the 4 hour. The daily is the same as the gold, but it gives you relative strength. So this is a reason I'm bringing this up is because of Emmanuel. He asked about how do I see strength or how do I see weakness? Okay, and one of the ways you see strength and weakness is through SMT, the eyes of manipulation. Okay, either it's distributing or it's accumulating. Okay, so what you can see here, can anyone explain what they see most recently on this weekly chart? Let's see, Roger, you're South African, so let's go with you. What do you see the ZAR doing that gold is doing?
Yeah, if I look at the last swing high that it made, I can see that not in the same week, but you can see that gold makes a swing low.
Okay, so if we are talking about gold making this swing high over here, okay, yes, it's not the same week like you said, okay, because you see here that if I choose this candle, which is that candle, it still went lower over here. However, the same process is made. It's not a case of, oh, it's this candle at this time, at this session of the New York session. It's to give you general bias or strength versus weakness. Okay, silver and gold is much more closely correlating in like you've seen. Okay, but this is also I'm showing you how to do strength, weakness, intermarket relationship. Okay, so an intermarket relationship would be this example to give you strength and weakness. So if, for example, we are looking at the high that gold made over here on the 7th of March, then this is the candle on the ZAR that made this low, but then the ZAR continues lower from that candle over here, okay, eventually bottoming out over here. And while it was doing that, if it was going lower here, then why was gold not going higher over here? Okay, so this is the weekly chart, and obviously it's a slow moving chart. It takes a whole week. So the effect of this chart is not always immediate in terms of the weekly. This could happen, you know, 1 week later, 2 weeks later, 4 weeks later. It's higher time frame, so it does, sometimes it has a level of precision, sometimes it takes a couple of days or many sessions for it to pan out. But this is where you can use an intermarket relationship of a commodity like gold with a currency like the rand, and then determine some kind of bias. And obviously this isn't the only one. I'm just showing you because I know there's a lot of you here that like to look at gold. So this is just one way to do it over here. So this would be the lower low, and then if that's making the lower low, then why didn't gold over here make the higher high effectively? Okay, and you know, it's really the same thing throughout. For example, here you can see that's based on swing low theory, swing high, swing low. When gold was sort of trading to this low over here, which is probably the same low you'd see or same high you'd see on silver, you could use an intermarket relationship. You could cross-reference your ZAR, USD ZAR, and your gold and your silver, and sort of give an intermarket relationship, and then you can use that on your high time frame, coupling with your IPTA data range that I just showed you in terms of price action, to actually take a trade based on a lower time frame. A lot of people, because they don't have a lot of equity in their account, gold is quite volatile. It's higher margin mostly than normal currencies. So generally you mostly swing trading, but there's obviously opportunity for intraday trades as well, depending on how much time you spend on the chart. But like if we drop it down here to like a 4-hour chart, it's really the same thing over here. So for example, I can quickly see one here. So when this USD over here moved out of this consolidation, which is always from here, we can see that when it failed here to make a lower low, gold was making higher highs. USD ZAR made a breakout or expansion out of that consolidation, then price retraced into that consolidation over here. So there was SMT over here like that, because if this is the low, then that's the high, and it's making high lows, for example. So that's not moving symmetrically, and then price moved out of that expansion. It found whatever, if you want to call it, resistance. Okay, great. Then it sold off and retraced, and then eventually it bought again over here. And when it bought again, while gold was making a higher high like this, where was the lower low on the USD? So it doesn't exist. So if this is the zone, relative zone over here, where the sort of your anchor of any of these two over here, you can see that it's not coming close to that zone. over here. So even though it's like hit and miss kind of thing, I'm not really showing you like the exact 15-minute relationship here. I'm showing you bias, okay, strength, weakness. You can see that there is weakness over there in gold, okay? So because if there wasn't, then why did this not occur like that occurring there? So there should have been that lower low, but there wasn't, and then price bought over here and over here. So this is moving symmetrically. So while this one made a low high, this one made a higher low. So that is symmetrical over there. So the symmetry would still lie that when this low here was made, this high here was made. So we could anchor from this zone over there to this zone over here, which gives us the relative point of where each made the swing low and the swing high. So now we would really just wait and say, well, if price is going to break this high, is the ZAR going to break this low over here? Because that would give you relative strength over here. And it's sort of symmetrical. If you can see here, there was a big void over here on the ZAR, right? This is a 4-hour chart. And at the same time, this gold basically did a similar move. So you can, what I showed you in terms of candle structure, use SMT. So like, for example, if it was to close this void, does this void over here close? Okay, but I'm not really showing you that. You want to pick a market that's more closely correlated like a silver, but it can be done. Okay, but I would generally suggest doing it on a higher time frame, not like 4 hours and stuff. This is showing you strength, weakness. So if this one now decides to come in and close this void, okay, what is gold doing when this one does not close, or if it does over here? Okay, so this is that relationship I'm showing you. Does anyone know or not know, or rather not understand, what is being shown here?
Then I have a query. Hello.
Yes, go ahead.
So Darren, saying this current latest price moment, right? When in USD ZAR, if a price comes down to close that void, but at the same time in gold, it is not, the price is not going up to close that void. So it means that, I mean, okay, does it mean that the selling pressure on gold is very high?
Yes, that's what it would mean. But for that purpose, Sivakran, what I would suggest is that for using SMT, using these candlesticks like I've done now with like corresponding voids and mitigations and things like that, it's best done with silver because it's more closely correlated. Whereas this is a couple of days after, sometimes not the same gap. I'm really showing you this for the purpose of using an intermarket relationship rather than trying to pick highs and lows. Because if you're trying to pick highs and lows, then I would definitely suggest using silver for this purpose. But I'm trying to show you that if you incorporate ZAR, for example, it is an example of a strength weakness indication, okay? Because we don't use a website where you type in, I don't know, currency strength
Indicator,
meter or something like this, okay? So yeah, you're going to click on this, and then this is what general retail traders would do, and then it's going to show you like I don't know, GBP currently's got a strength of 0.5 and NZD's got a strength of 0.5 and etc. etc. We don't use indicators like this. We use what I'm showing you here to determine the relationship of other asset classes or similar asset classes. Okay, so that's what I'm showing you here. Is strength.
Yeah, that's yes, that's understood. I mean, assume if the same chart instead of that USDs are right, it's the same scenario. It is going to be silver. but the underlying assumption is that the selling pressure on gold is high. That's why it is not coming to fill that void.
Yes, you could even go here if you wanted to. You could really go and test this out. I don't trade gold that much, Sivakaran, but I'm just showing you how you can determine this. So, like for example, this is a 1 hour chart, right? And it's for the most part like 80% symmetrical, right? And then there's times where it's not, right? So, like for example, over here there was this large rally over here on the SAR, okay? And based on your PDA, because your PDA would come from this is the swing high of the ray, and this was the low, and it
Low.
moved away from the low, and now it's moving towards this high because that's the swing low and the swing high based on the PDA. So when it trades into what is this?
Rejection block.
Okay, so if that's a rejection block, then this rejection block is this rejection block, right? In reverse.
Yeah, yeah.
Okay, so in terms of symmetrical versus non-symmetrical, the same way I'm saying so symmetry versus this 4 hour fair value gap over here, or this liquidity void, if it gets traded into but gold does not, it works the same way as if this rejection block was traded into by the USD ZAR, but this rejection block here on gold was not traded into, then this too is SMT, because there is the higher low and there is equal high.
Equal high.
You see, so although using external range or internal range liquidity pools of old highs and old lows is always best for SMT, you can, if you know how to use SMT and understand what I'm saying here, you can use any array you wish to.
Okay.
Okay, because if this is an order block over here that is, say, bearish, right, on gold, you can see that there's no order block here, right? So
Yeah.
if we were to narrow this down, although there's no bearish or rather reverse bullish order block on the ZAR, this void is the same as this void.
This void, yeah.
So this void closed, right? But this void did not. Now, yeah, sure, that's a non-symmetrical market move, but you don't base ideas that you trade solely on the purpose that this is SMT and this, I'm going to buy this now or sell this now because, you know, there's SMT. You need to back that SMT up with something in the price action like order blocks or voids or things like that. That's why I said when you showed me that picture the other day, it looks like it's only SMT, which is fine, but then you need something to confirm it. So what the normal suggestion is if I make it here, so either you do this, so either you use SMT, right, on a, let's say, daily, I don't know, weekly, for example, okay, as a higher time frame, and then that's your confluence. So let's just put that as the abbreviation of confluence. And for confirmation over here, if daily and weekly give you an SMT to sell, okay, your higher time frame bias is based off daily and weekly for a sell, then any confirmation you find in the form of, I don't know, daily, 4 hour, 1 hour would also be to sell, because you've used daily, weekly as a bias indicator for selling. You would use a confirmation of a premium price array to sell. Bearish order blocks, bearish liquidity void, mitigation block, etc. Whatever you would find on the, can be the same time frame, like can also be found on the daily, for example, maybe the 4 hour or even the 1 hour. Really depends on, you can even go lower if you want to. Okay, so you can do it that way, or you can do it in reverse, where for example, let's say the daily and the weekly over here give you a confirmation that there is a, I don't know, weekly bullish order block. Or a weekly buy side imbalance. Okay, so your higher time frame is coming from a D1 or a week one, okay, as a confirmation, and then your confluence is coming from maybe a, I don't know, 4 hour or 1 hour or whatever time frame you choose. Okay, one should be higher, one should be lower, because obviously, unless you like swing trading or something, you want to use sort of a blend of both. Okay, lower time frame for entry, obviously. So whether you choose to do SMT as a confluence on the higher time frame or SMT as a confluence on the lower time frame, there's something must come from the higher time frame, whichever way you choose to do it. It doesn't have to be SMT done on daily, weekly. SMT can be done on H1, H4. Okay, but then as long as you've got something to tell you the opposite of the higher time frame. Does that make sense?
That's good.
Okay, so that would be,
And
yeah,
any reason that you are not trading gold?
me. No, I just prefer to trade gold. Sorry, GBP USD. That's my poison, I guess. It's
Okay,
no reason, I guess.
okay.
Okay, so then if ZAR was one of them, okay, there is another one. Does anyone want to give it a try as to what it is? Currency? Any other currency, guys? In the world? Any idea who the answer to this question is going to be?
No idea.
Take a guess. Wild guess. Any country?
AED?
Swiss
Is it
franc?
Nope. Nope. Wait, what did you
AED?
say? What did you say? What did you say, Temitope?
I said Swiss franc.
Ta-da! 100% correct. Switzerland is actually the world's largest exporter of gold. Okay, so it's only natural that it has an influence on, gold. So when we talk about, in general, the Swiss, okay, we're not comparing like USD ZAR, okay? You don't have to use any of these methods. You can only use silver if you prefer to. I'm just giving you insight here, okay? So if we were to say Swiss, okay, we'd say Swiss futures, because when you say a future, it's like the entirety of that whole currency, right? Okay, so similar sort of situation over here. You can see that they move relatively similar. Does anyone not see that?
Yeah.
Now, again, it's not like this hour candle made a bullish order block, so then on gold, there must be a bearish order block. It doesn't work like that. If it did, then I'm sure I wouldn't be wasting time, and you wouldn't be wasting time. We'd all just be as rich as hell, and we'd be retired already. So no, it doesn't work like that. That's why there's the element of surprise sometimes, and not reading the market correctly. So yes, it's similar, but not the same. So like, for example, here you can see that this high over here, this one makes no sort of new moved lower here when this one does over here. So there's like a non-symmetrical market move over here. Does anyone not see that? And even over here, there's like a relative equal low here, but there's no relative equal low here. Everyone see that?
Yeah.
Okay, I'm just showing you, I'm giving you insight. I'm not going to spend a lot of time on this because I'm showing you this so you can go and test it yourself. There's many other ways. So like, for example, if I had to say, whatever, WTI, who here trades oil? This one's a bit choppy, so let's just say US oil. Anyone? Does anyone trade oil? No one. Okay, well, it doesn't matter. Does anyone know what currency is linked to oil? Well, obviously, there's quite a few currencies linked to oil, but one of the most...
Canadian dollar.
CAD.
That's it. CAD. So you could come in here, and there'd be a couple of options. So like, for example, CAD JPY is just one of them. Okay, so generally, like, for example, we know that the Ukraine war has caused the move of higher on oil. Okay, not really, but anyway, you know, that's what they say in the news. But while oil moves higher, you know, CAD JPY generally moves higher. Okay, I'm not saying it's like exact, but it's similar. Okay, and the same too can be said with the corresponding intermarket relationship, is that the one makes a failure swing, the other one makes a higher high, SMT, etc., etc. Again, this too, like if we were to compare a 1 hour chart, does not make the exact same moves. However, it is similar. So, for example, like you pick a high. Now, it doesn't happen very often, but there's times when the market is moving symmetrically. So, like, let's look at the most recent price action over here. And we see over here, the market is doing what? This is non-symmetrical, because remember, what do we have to do to the chart? Quickly.
Invert.
Invert.
Yes, why do we have to invert it? Because if it's so closely correlated, then you need to see the times when it is non-correlated or sort of non-symmetrical.
Non-symmetrical.
Okay, so here, most recent price action, high, 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 low. Simple, right? Okay, again, it doesn't always occur, and it's not always going to be honey bunch. But here, general consensus, where's the higher high and where's the low low here? There wasn't, so boom, SMT, right? Okay, it's not like every single pair you can, oh, the corresponding liquidity void to the corresponding liquidity void is not being filled, so therefore that's SMT. You will have to practice this, guys. Look there, there's a corresponding liquidity void, which is if there was a liquidity void over here, which is this candle here, this one should be filled over there. And when this one traded higher, or sorry, lower, this one traded through it, so that's a buy signal over here. Okay, again, based on higher time frame, same thing, using the same approach. If this is moving higher and breaking this high here, then why is it not breaking that low? Sort of the same thing over there. Okay, corresponding asset class. Okay, there's many relationships like this. Let me just do one here. Don't answer this, Richmond, or if you are in here, Ronald. If I'm comparing gold to silver and I'm comparing Bitcoin to US dollar, what is the corresponding asset class of Bitcoin? Quick, come on. What? Come on, guys. Hey?
Is it Dixie?
Nope. Roger, you use Bitcoin.
Ethereum?
Here we go. ETHUSD. Okay, but what do we have to do? Because they are both not the quote pair on the USD. What do we have to do?
Invert.
Invert. Okay, so there we go. It's already inverted. Perfect. There we go. So this again, It's not always clockwork, but really the same thing. Confluence versus confirmation. Here is SMT, here is SMT. Where is the high high? If that is the lower low. Well, actually, it's inverted. So that was actually the higher high, and that was the higher, no higher high. But really the same thing. Similar situation here. There's one there, there's one there. Guys, you're going to have to train your eye to see this as quick as I do. If you can't do that, then you need more practice. But basically, it's really the same thing. So like, for example, this over here was an order block, bullish order block, but in reverse bearish order block. So if that's the bearish order block over here on Bitcoin, corresponding asset class is Bitcoin to Ethereum. So this one did not mitigate over there. So this is the bullish order block, that is the bearish order block. This one traded into that order block, closed a little bit of this void here. Why did it not close this void? This is actually quite an identical pair if you do like to trade crypto. I'm only bringing this up because there are people who like to trade crypto. But yeah, there's obviously times based on both lower time frame and higher time frame where price is correlated and sometimes not correlated, and you're looking for the times when there is no correlation. So like if you go to a weekly chart, for example, most of the time it's going to be moving symmetrically, but there will be times where it is not moving symmetrically, and you're really just going to have to practice it. So based on the weekly chart, what does it tell you? It tells you that you should see manipulation occurring, and the manipulation should generally occur at, you know, the most highest points of premium and discount, not just really anywhere inside of the range. Occasionally there'll be a time in like an internal range liquidity point where there will be a manipulation, but most of the time there'll be buy side liquidity or sell side liquidity, and then price will be manipulated the most. That's why I always say external range liquidity is generally the best, but you know, it can happen pretty much any time of the day. Okay, guys, so you can, you know, decide what it is that you want to trade based on whatever asset class. You can, you know, do bonds, stocks, whatever you wanted to do. There was just one more I wanted to show you. For example, this is the Euro X, just like the dollar X or DXY. Anyone know what we can compare this to? Euro, JPY, if you trade that, I don't know. That's something you compare it to. Okay, so you want to see strength, weakness, dollar index like GU, but this is not the dollar index, this is the Euro index, and then you get Euro GBP. So obviously that's a weekly chart. So if you want to do something on a daily, you're going to look for times where it is not happens the most at external internal range liquidity. So this is the highest level of premium, and there is a higher high. Where is the lower low? Or, you know, it's not corresponding, so it's making equal highs. There we go, manipulation, boom, it sells. This is also not one of those times where this is the bearish order block and that is the bullish order block, so that is a correlating asset. Okay, although if you do practice it enough, you might be able to see it. Okay, I don't really trade Euro X with whatever Euro is. You know, you can do it on Euro NZD, Euro JPY, Euro CAD, pretty much anything Euro linked. Okay, what I generally would most of the time look for is like a Euro GBP, because that would be related to my pair GU. So, you know, obviously it's the same quote pair, so it has to be inverted. So while the one sells, the other one should buy. And then, you know, you're going to look for correlating. It's going to be so very similar. So let's see, most recent one over here, manipulated down. This is a daily chart. So over here, there was manipulation down and manipulation down. So that was like sell over there. This one traded into that liquidity void. This one didn't. So there's your liquidity void. Below that low. Didn't trade below that low. So higher low. And over here, this one, high high. Okay, so this one traded into the liquidity void. This one did not. And that's another example that you can use. Really up to you how you want to use it, but for the most part, today's exercise was to do the up-to-date range, and that's generally your homework to practice it. But yeah, go watch the recording again, and you should be able to learn something. I think we'll do questions on Friday because, yeah, that would be the best. Go work through this, and then from there see what happens. Okay, guys. Well, that's it for now.